Just a little while, we will get the latest consumer inflation data for the month of June. The CPI print is forecast to show a rise of 3.1% on a year-on-year basis. For insights and possible implications for the Fed, let's bring in Mohamed El-Erian, the chief economic advisor at Allianz and president of Queen's College at Cambridge University. Mohamed, it's always great to see you. The market's already pricing in a hike at the next meeting. So, is this number going to change the Fed? The market is giving the Fed permission to go again. It seems to want to go again. Does it change anything?
I don't think this number is going to change anything for July. The market is now pricing 90% probability that they'll hike. And I think that's absolutely right. What's interesting is September. There, the market is just above 20%. I think the actual probability is higher than that. And what today's number will influence is the September implied probability of a rate hike.
So how do you think the number is going to come in? I mean, do you think that it will be much softer? We've had forecasts from Tom Lee, which we've been talking about earlier this week, that the S&P would go up 100 points within the next week, implying that the print would be much softer than the already soft print the market is expecting.
Right. So we've entered a nice period for the CPI headline inflation prints. I think we'll get around 3% today. I think it's going to be well behaved on an annual basis because of the base effects. But me and many, many others are going to be looking not just at core, not just at services, but asking the question, can you maintain goods disinflation? That's what has gotten us down here, particularly energy, while also starting to see services disinflation. That is the big question. I worry a little bit that people are jumping to the conclusion that goods disinflation will immediately translate into service disinflation. That's not what we're seeing in the rest of the world. So we just got to keep a really close eye on that. Why
would there be a more profound lag between the two in this case? Is it just because you're seeing consumer spending on services there's still a lot of pent-up demand? We transferred our spending from goods to services sort of much later in the game, that's for sure.
Absolutely right. So one is that demand still favors services. Two is that the service sector is less sensitive to interest rate hikes. You need to do a lot more on interest rates to get to the service sector as opposed to the goods sector. Mm-hmm. And then the third issue is wages. We got to keep an eye on wages. We don't want to fall into the trap of the UK, where the UK now has become an inflation process where wages are growing by 7%, with the private sector growing at 7.7%. And that's just a natural reaction to people's purchasing power having been eroded for so long. So keep an eye. Just let's not jump to conclusion. We've got to keep an open mind. The Fed has made many mistakes on inflation in the last few years, and one of them has been not to look at enough scenarios. And we've got to keep our mindset open to various scenarios.
I'm glad you mentioned that UK example, Mohamed, because that sort of gets at this bigger question, and that is what causes wage inflation? Is wage inflation a response to just rising inflationary pressures and the need for workers to be able to keep up with the cost of living, or is it vice versa? And I think, where do you stand on that? Because I think that's sort of key to understanding whether or not the Fed feels the need to knock the labor market down more.
You're absolutely right. And it is both. You can get to a phase where you are in the UK today, where where inflation are both fueled and fueling higher wages. Fueling higher wages is easy. People are trying to protect their purchasing power. They ask for higher wage increases. And if they're in the service sector, they have pricing power. Fueling is the service providers feeling that they can pass through the higher wages into higher prices and therefore fuel inflation as a whole. That is where the UK is today. The key issue is it speaks to the need for more than just central banks to lower inflation. You've got to act on the supply side. If we just simply focus on central banks and simply focus on the demand side, then you have a risk to economic activity. Unfortunately, the debate is all centered right now on central banks and doesn't look at the whole range of tools we can use to have the soft landing we all want.
Do you think Jackson Hole will be a pivotal moment for the Fed? And I know we're looking out a little bit, but it's actually coming up faster and faster as the month goes on. And do you think that they could use that opportunity to reset any sort of expectations beyond this press conference?
I think they're uncomfortable, although they're less uncomfortable than they were a few months ago, that the market hasn't believed them in terms of how many rate hikes we're going to get, 2 more, and where we're going to stay for a while. The market is more dovish than the Fed has indicated. And the good news is the market has slowly been converging towards the Fed is, but the market is not there yet. So it wouldn't surprise me if they try to realign expectations. I think the bigger question, and I don't think we'll hear it in Jackson Hole, but we do need to discuss it, is what is the right path to 2% inflation? If you get there too fast with all the problems on the supply side, you will sacrifice a lot of demand. So there needs to be a discussion as to what is the right path, but that's something that the Fed doesn't want to discuss right now.